Well, welcome into today's featured presentation, ladies and gentlemen. Welcome into the dark world of investing, where I just stuck over $7,000 into a dividend stock here today, okay? Now, in the course of this video, I have two objectives. The first objective is to share the dividend stock I bought. I don't think that's that important, okay? Everybody gets caught into, oh, what stocks he buying, what stocks he's selling. I think that part is much less relevant than the second part of this video, which is going to go into my thought process in terms of buying the stock. Someone that's been in this market for over 10 years now. What is my actual thought process behind putting over $7,000 into a dividend stock here today? We know this is a year where I'm taking dividend investing more and more serious than ever, but what is the actual thought process? Because basically, here's the simple process, okay? If I put my money into something, I'm buying an asset, I expect to double my money in the next 3 to 5 years. I don't just buy stocks to buy stocks like, oh, let's just, spend some money out there and put over $7,000 into a stock. No. When I go to buy a stock, it's because I believe I will double my money or more than double my money within a 3 to 5 year span. And if it doesn't meet that type of criteria, then I'm not doing it. And I believe this stock I'm sharing with you guys here today, I believe I will double my money or more than double my money in the stock over the next 3 to 5 years. And I want to share with you why I believe that, okay? So smash that thumbs up button if you enjoy a video like this where I go into depth on this. When you guys hit that thumbs up button, it lets me know that you enjoy a video like this where I talk about an individual stock and I go into my thought process around something like this, guys. So hope you enjoyed today's video and leave me a comment down there if you guys are buying any stocks. One thing I want to cover before we get into this is the stock market just had its worst week since 2008. Okay, its worst week since 2008. So real quick here, all you guys give yourselves a pat on the back because you just went through one of the worst weeks in stock market history, and we've just been through one of the worst months in stock market history, okay? This has been unprecedented. This has been one of the worst times ever to be involved in the stock market, essentially. So, put that little badge on your chest and be proud that you have made it through to this other side and you're still alive and you're still here after going through something dramatic like we just went through with the stock market. I mean, that was unbelievable. Unbelievable week. Unbelievable past month, needless to say. There's never been a time period in history where the Dow lost 10,000 points in a month's time. Like, that's just, it's crazy, guys. It's absolutely crazy, okay? Now, with that being said, let's get into this stock. So the stock I bought here today, over $7,000 worth, is a company named Tapestry Company. And I'm going to go into depth on this one, my thought process around buying a stock like this, okay? Ticker symbol on this one is TPR. I bought, it basically went through two different trades. One bought 400 shares at $11.97, and I guess, 5 at the end. And the other one was another 185 shares, went through right at $11.97, okay? And you add up those two trades in total there, and it's a little over a $7,000 move for me here today, okay? Now, once again, I only put that money in the stock because I believe I'm going to double my money or more than double my money in the next 3 to 5 years. So what gives me the conviction to put that amount of money in a stock like this here today, okay? Well, first off, let's get into actual Tapestry Company. What is this company? You might have never heard of it, but I can almost guarantee you've heard of some of these brands before. They own the Coach brand, they own the Kate Spade brand, and they own the Stuart Weitzman brand. And in a time like now, what we're going through, I think brands are going to be more important than ever. Whenever you come out of a recession scenario, brands are so very important, okay? These brands are going to be so important into the future. Well-known brands, well-established brands are vital, okay? So if you don't know, the Coach brand is basically known for handbags at the end of the day. They make backpacks and other sorts of things, even some footwear products and whatnot. But the Coach brand, if you know of the Coach brand, you know of it because of purses, handbags, wallets, and items like that, okay? The Kate Spade brand is actually very similar to the Coach brand, but it's not nearly as big. It's not nearly as well known. Certainly a lot of people in the United States would know of this brand, especially a lot of my female viewers out there, also known for wallets, handbags, purses, and things like that. But their styles are a bit different than the Coach brand, where the Coach brand's a little more traditional, and Kate Spade brand, is a little more, I guess you can say, colorful, and kind of is going after two different markets. One's going after more of a modern look, and one's going after a more traditional, just kind of a rich feel, which is more like the Coach brand, okay? okay? And then they also own the Stuart Weitzman brand, which Stuart Weitzman is basically a high heel company, okay? They think of footwear type products. A lot of the women that get Stuart Weitzman get them for some of their high heel products, and it's a footwear company at the end of the day, okay? So those are the three brands, three very strong brands, especially the Coach brand. That's by far their biggest and strongest brand, all right? So let's go to Tapestry Investor Relations page. We always go to the Investor Relations page to start doing some in-depth research on some of these companies. We're going to go ahead and look at two SEC filings. Why do I want to go to the SEC filings? Well, I want to go to their latest quarterly report. I want to know how much cash this company has in their balance sheet. This is always vital. This is something I pay attention to, whether we're in a horrible market like we are right now, and we just had a stock market crash, right? And it might not be over, might still be coming. But needless to say, we've just gone through that. We're in probably a recession scenario right now because we're not allowed to even go out of our houses and spend money right now at businesses. So needless to say, that's probably not good. So balance sheets, I always pay attention to, whether we're in hot times, cold times, anything across the board. And right now, more than ever, a great balance sheet's important. Look at the cash, guys. Over $1.1 billion in cash and cash equivalents and short-term investments on their balance sheet. That is a monstrous number. That is a monstrous number, especially when you take into account that this company's, the entire market capitalization of this company right now is trading for about $3.3 billion. So which means they've got about 30% of the value in the company is just sitting around in cash and cash equivalents and short-term investments. I absolutely love that. And if you think, with a question like this, a lot of people are wondering, are some of these companies going to make it? Will this company, Tapestry, will they be able to make it through this short-term, super bad economic environment we're in and make it to the sunshine days when we get over to that other side? And the answer to that question, in my opinion, is without question, yes, they will be able to make it to the other side. And it's not even really close on this one because it's such a small company compared to how much cash they have, and compared to any type of short-term liabilities this company has. So needless to say, a company like Tapestry, I have 0% fear that they would ever face bankruptcy or anything negative like that negative of a thing would happen to them in the short term. There are definitely a lot of companies and a lot of brands that will be facing some major financial trouble. Tapestry, not one of those type of companies because they are loaded when it comes to cash and short-term investments. And that is phenomenal. I love to see that. Balance sheets are always important. Now, keep in mind, this company, look at this, okay? Less than a month, the stock has fallen, 60%, over 60%, in less than a month, guys. In February of 2020, February 21st to be accurate, this stock was trading at $28.38. It's $12 here today. It is priced, this stock is now priced like it's one of these other companies that's, going to face some bad financial situation where they could go under or something like that. That's where this company is being priced. And that's why I'm so interested in adding shares here, and I will continue to add more and even heavier if this stock went lower. Because we're in a stock market right now that unless you're a company that sells like toilet paper or disinfectant wipes or something like that, like your stock is getting hammered. And Tapestry here, amazing balance sheet, amazing brands, and Wall Street and people are just like, we're selling the stock, we're selling the stock, we're selling the stock. I don't care if it's down 60%, 70%. I don't care that they have $1.1 billion sitting around in cash and the market capitalization is just over $3 billion in this company right now. We don't care that this is in any type of normal economic environment. This is an extremely profitable business model. People are just like, we don't care right now. And when everybody doesn't care, that's when I care more than ever, needless to say, okay? Now, let's go ahead and start breaking down some of the financials behind some of these brands. We want to look a little deeper at a company like this. We know they have amazing balance sheet, no doubt about that. We know they have super strong brands, okay? Tapestry, $6 billion they did this past year in revenue, a large number. Keep in mind, I'm buying this whole company right now for $3.3 billion. It just did $6 billion of revenue in this past year. A very healthy operating margin of 15.8%. Okay, they got 1,540 stores total, all right? Now, obviously, I have it circled. Their cash cow business, their main business, the one that really drives the huge results for the company is Coach. Without question. I mean, the numbers are just staggering for that brand. $4.3 billion of revenue they did in this past year. Just the Coach brand, okay? We're not talking about the other brand, just Coach brand. Look at the operating margin for Coach. I mean, that is incredible. An operating margin of 27.1%. Very, very, very strong operating margin, needless to say, for the Coach brand, all right? So that covers Coach, that covers the company in total. What about Kate Spade? Well, Kate Spade's kind of their middle-ish company. Now, I don't think Kate Spade's going to get to the size of Coach anytime soon, if ever, okay? Let me be very clear about that. This company just did $1.4 billion in revenue in this past year. I believe that brand will continue to grow in future years, but I'm not solely convinced that they'll ever be able to get to a place they're doing the type of revenue numbers the Coach brand is. But I believe that operating margin will over time get to a place very similar to Coach. Maybe not up to 27% operating margin, but I believe it can get into that 20%-ish range. And so if you're talking about a Kate Spade brand, that could turn into a brand that's maybe doing $2 billion, $3 billion if you're looking at like 2022, 2023, somewhere around there in terms of revenue, and they're putting up an operating margin of, let's say, 20% or 22% at that particular time. And then you have Coach brand on top of that. You're talking about a company that could see profitability go up quite substantially 3 years out from now, 5 years out from now, and things will get really, really fun with the stock as a company can get closer and closer to that situation, okay? So definitely excited about Kate Spade. What about Stuart Weitzman, okay? SW. That's a very small brand for the company as of right now. It's a brand, I mean, small. Isn't it funny talking about a small brand for a company and they did almost $400 million in revenue last year? But when you're talking about some of these companies that are huge, you know, $400 million from a brand is not much, okay? So Stuart Weitzman is a growing brand, but it is a brand that has a very negative operating margin. We're talking, you know, negative 4.3%. I believe over time, this company will be able to get that business to a positive operating margin. Maybe something close to a Kate Spade. Maybe, you know, a 13%, a 10% operating margin, somewhere around there over time. I think they can get that business model too. I believe they're going to get to a 20% operating margin anytime soon. I really do not. But I believe if they work on this a lot over the next 3, 4, 5 years, I believe they can get it to something over a 10% operating margin, which would be phenomenal for the business because that would put all the businesses in a very healthy operating margin environment over time, okay? So definitely very excited about that. Let's take a little further look into some other things that I think are very vital, okay, to understand about their business model. So women's handbags makes up half the business for the company. It makes up half the business for the company, and you can kind of expect that. I mean, when you own Coach and you own Kate Spade, these are two businesses that are very, very focused on handbags and purses and things like that. So needless to say, like a lot of your revenue and your profits are going to come from handbags. So women's handbags makes up half the business. So that's going to always be extremely important for this company over time. By the way, men's is now 14% of the business. So I got to say, the men's business has grown quite substantially over time for the company, okay? Obviously, still a huge untapped market for the company for the most part. North America generated about 61% of the revenue for the company in the past year. So North America obviously is the cash cow business. It's their most important market, but they should be able to continue to expand these brands in Greater China over time and in Asia in general. So over time, these brands should be able to continue to expand around the world. And I think long term, they can get it to maybe somewhere around like 50% of their business comes from North America and 50% comes from rest of world. I think they're going to go that route over time, okay? But North America probably always be the main cash cow part of their business. Now, what really excites me is this number here. Let me explain why. So direct to consumer represents almost 90% of their business, 89% of their business, while wholesale represents only 11%. So if you don't know, wholesale is basically you sell into a retailer. So let's say I'm a retail shop and I want to sell Coach items and Kate Spade items and Stuart Weitzman items and things like that. Let's say I'm a retail shop, okay? So if they sell me items and then I sell those to customers, that's wholesale business for them. Direct to consumer would be like they sell from their own retail stores. They sell online, like you go to Coach.com or KateSpade.com or StuartWeitzman.com, and you actually place an order. That's direct to consumer, okay? So direct to consumer is making up almost 90% of the business, and I think this is so vital, okay? One of the two reasons this is so vital is obviously we're talking about a lot of retailers are facing a lot of problems right now. And a lot of them may end up going bankrupt or already are going bankrupt. We obviously saw Macy's today halt their dividend. They're withdrawing guidance. There's a lot of talk that Macy's could go under or within the next couple years. Okay, Barney's faced bankruptcy very, very recently, and overall, there's just more store closures in terms of retail than there's ever been before, and more folks are shopping online, and this is forcing a lot of these big resellers, these wholesale customers, to basically go bankrupt. You're looking at a company like Tapestry that is not nearly as reliant on that wholesale business that is struggling in a major way right now. Okay, and also when those wholesalers, when they start facing bankruptcy, guess what they do? They start discounting products. When they start discounting products, they can actually hurt a brand reputation bad. There's a reason why Louis Vuitton never does sales. Louis Vuitton never does sales, and they're able to uphold such a great brand prestige over time in the luxury space. And you don't want to be in a situation where you're selling into a retailer, that retailer's facing bankruptcy, and they're just blowing out your products, and everybody comes in the store and it's like, oh, there's your Coach bag for 85% off, and it's just like, oh man, who wants a Coach bag? I guess it's really cheap or something like that. So I love the fact that direct-to-consumer sales represents 89%, and also you're controlling your customer base a lot more than just being reliant on these big retailers to basically sell to your customers. When you have a direct-to-consumer relationship, you can actually have phone numbers of the customers, you can have email addresses, and people can be used to going into your actual stores to buy products or going to your actual website to buy products, which I think is much more valuable than somebody just browsing around a Macy's or a Dillard's or one of these other retailers that might end up going bankrupt. And so needless to say, I like that with this business, okay? Now, in terms of the chairman and CEO, I always tell you guys, management teams are very important to pay attention, especially when it comes to the CEO. So this gentleman has been around the company for years and years. On the board of directors, he served as chairman of the board. He understands the business model very well. He's seen it go through a lot of different times, economic environments that were great, economic environments that were very bad, needless to say, and everything in between. Now he's seeing this situation. But I think something very important to understand about this gentleman, he spent his first 20 years of his career at Goldman Sachs, where he held a number of senior management positions, including serving as Global Chief Operating Officer of their investment banking business. Now you might ask, why is that important? Okay, why is something like that important? Why do I want to highlight something like that? Well, remember what type of economic times we're in right now. A lot of fear out there. A lot of businesses and brands talking about possibility of bankruptcy, especially if things don't get back on the right track very soon. And needless to say, a lot of fear out there. Assets across the board have decreased, including the stock price, right? And so when you have an environment like that, guess what? Brands start getting desperate to possibly sell. And if you're somebody that's worked in the investment banking industry, you can probably get financing pretty easily. You know how to get financing on the cheap, and you know probably how to do deals very well. So as some of these companies maybe possibly need to sell out, you can buy some of these companies for a dime on the dollar, a nickel on the dollar. And when you're in an environment like that and you have experience with investment banking, you know how to work deals, you know how to get financing if you want to finance some of these deals. The Tapestry company could be in a position where they are able to pick up some great growing brands that are maybe going to go through some tough things here short term, in which some of these companies were not prepared for. And a company like Tapestry has $1.1 billion sitting on their balance sheet to buy some of these brands on the cheap or get the financing in place that they can borrow money for so cheap. We know interest rates are, it's just like borrowing money for free right now. So a company like Tapestry is in a really strong position, and they have a CEO that is kind of the perfect CEO to be in a situation like this, to hopefully take advantage of buying some great brands that are going to go through some very bad, financial situations here and might have to sell, and they might have to sell to a company like a Tapestry just to be able to make it through. Or you maybe get equity in some of these brands that are struggling right now. Maybe give them a loan and get 20% equity, 30% equity. When everything comes back and those businesses are doing great again, guess what? You can sell out of that and then just keep the cash from it. And so needless to say, there's a lot that can happen there. And I think if you're talking about somebody that's in a good position, I think this gentleman is definitely in a good position to make some things happen there. And I would love to see Tapestry take advantage while basically the market's going to be down, obviously, in 2020. And a lot of these businesses are going to be scared, okay? Now, let's look at some more financials here. So when we're looking at Tapestry company, this is a company that just in the past year had gross profit of over $4 billion, a large number. over $4 billion gross profit, $2.57 of EPS, which I think is pretty dang impressive considering this was a year where companies like a Tapestry had to basically deal with the whole trade war situation, tariffs, and a lot of these products are made in Asia, in different parts of Asia, a lot of their different products. And needless to say, their earnings got hurt very substantially because of the tariff situation. So to still put up those type of numbers in the type of environment, it gives me a lot more confidence that this company will bounce back very strong as we start to come out of this huge, recession kind of scenario we're in, where we're not allowed to spend money for several months. So as we come out of this through the back half of this year, into 2021, into 2022, I believe this is a company that will be able to get back on the right track and get this company to be very, very profitable in the future once again. Now, this is also a dividend stock. I'm buying this because it is a dividend stock as well. Now, keep in mind, this company, along with a lot of other companies out there, most dividend companies, are either going to cut their dividends or put them to zero. Let's put it that way. They might, cut them to half, maybe like, oh, we're going to cut them by 50%, or just take them out in general. So I do not believe in the short term I will get this dividend, but it's something to keep in mind. Long term, I will probably get this dividend as a long-term buyer of this stock. Keep in mind, this is a yield over 10% right now, 10.62% yielder right now. Now, even if they cut that, let's say they cut it in half, I still get a 5% plus yield if they cut it in half. And let's say they cut it to 100%. That's fine. Keep your cash around. Buy some of these undervalued brands. Bring the dividend back in 2021 or 2022. And I'm sure that dividend will be very fat compared to what I'm buying these shares at here today, needless to say. So with all that being taken into account, I believe this will be a stock that will be a very successful stock for us over the coming years. Could it go down more in the short term? Absolutely, and I will gladly be a buyer of this. So many people, get scared about, well, you bought in today. What if it goes down to $10 or $11? I'm here to be a buyer. I didn't put all my money in the stock clearly today. I bought $7,000 worth. If it goes lower, I will continue to be a buyer, and I welcome it. If this stock goes down to 10, 9, 8, any price across the board, I would gladly be a buyer because this is a company that will make it through this short-term negativity. And when they get to the sunshine days, this will be a company that, is profiting $500 million, maybe $1 billion+ a year. And as somebody that has a multi-year outlook on this, I believe this will be a stock that we can double up our money, or more than double up our money in future years, guys. But I would love to hear your opinion on this stock down there. Don't forget to smash the thumbs up button. That lets me know that you enjoyed a video like this where we go into depth on a stock like this in particular. Thank you for watching and have a great day.